What's up, everybody? Welcome to another episode of Swan Signal Live. I'm your host, Senior Analyst Sam Callahan at Swan Bitcoin. Got another excellent show lined up for you guys today. But before we get into that, I want to bring up Pacific Bitcoin. Pacific Bitcoin is the festival that we put on in beautiful Santa Monica every year. It's happening October 18th and 19th. If you use the promo code SIGNAL, you can get 10% off right now. And if you use Bitcoin, you can get an additional 21% off. That's 31% off. Go to Pacific Bitcoin, check it out. Got a bunch of great speakers lined up, workshops, side events, and it's just a great time to go enjoy some California sun in October. So Pacific Bitcoin. For this episode, that we're going to be talking about all things Bitcoin mining. It's kind of the topic right now, given that the halving is about 1 month away. That is when Bitcoin's issuance gets cut in half, as you've probably heard. And I can't think of two better guests to bring on than Luxor's head of derivatives, Matt Williams, and head of research and content, Colin Harper. Welcome to Swan Signal Live, guys. I'm really looking forward to this conversation.
Thanks for having us.
Thanks for having us on, Sam.
Yeah, I feel like, Colin, we've known each other for a while. We actually both lived in Denver before I even worked in Bitcoin. I knew about you, so it's kind of coming full circle here.
The early days. Shout out to the Denver Bitcoin meetup run by a guy named Blockbane, and I think also Zach. I can't remember his last name, but goes by BTC BAP. He was kind of helping with it at the time. That was wild. It was like you and also Bikes and Bitcoin. I'm blanking on Rob's name. Yeah,
Rob was there too, and
Rob was there, and he wasn't in the industry yet, and like so many people in that I don't know, in that scene got, great jobs at some great Bitcoin companies. So it's really cool to see.
Yeah, they got scooped up. I think Rob might be doing something on his own now, if I'm not remembering correctly.
He did like this Bitcoin mining company called Distributed Hash. They had some mining hosting in Wyoming, and then he got poached by Riot.
Actually, that's right. Oh yeah, he's at Riot now. That's right.
Yeah, he wrote a pretty awesome book too called The Bitcoin Miner's Almanac. Definitely recommend anyone checking it out who just wants to learn more about Bitcoin mining, because it's a pretty good little rundown on all the economics and other things that people have to worry about when they're trying to produce corn for under spot.
Yeah, Rob's a smart guy, and it's like what you said. I think Zach wasn't working in the industry either, and now he went over to Casa, and it is fun to see how those early days, that crew who we were just drinking beers talking Bitcoin, now a lot of us are working in the industry. That's fun. And Matt, dude, we just found out that we actually grew up near each other, which we didn't know. But welcome to the show too, my friend.
Yeah, thanks for having me. Appreciate it.
Yeah, so like I said, we're going to be talking all Bitcoin things, Bitcoin mining related. Let's maybe just do a little review of 2023, because 2022 was just a complete bloodbath when it came to Bitcoin mining, with the price going down. Hash price, which we'll talk about, really fell to like historic lows. And then 2023, we saw kind of a big resurgence for Bitcoin miners with the price, hash price kind of increase. We saw some new use cases for block space, which helps Bitcoin miners as well. So maybe let's talk about 2023. I'll throw it to you, Colin. Just give it like an overview of the differences from 2022 and 2023, and how miners are feeling, I guess.
Yeah, so you kind of gave a really good high level just then. 2022 was a brutal year for Bitcoin miners. Obviously, Bitcoin double topped at the end of 2021, and it was nothing but tumbling all the way down for 2022 until we had the kind of final capitulation moment during the FTX bankruptcy, where Bitcoin puked from like 20K to like 16 or 15, I think was the bottom in November of 2022. And at that point, you had Bitcoin miners basically butting up against the lowest point ever for their revenue earning potential. And this is what we call hash price. So if you ever hear a Bitcoin miner or someone in the industry talking about hash price, what they're basically talking about is the revenue that a miner can expect to earn for a unit of hash rate over the period of a day. So this is usually denominated in either terahashes, dollar per terahash, or dollar per petahash. So at the end of 2022, hash price was at like $55 to $60 per petahash per day, which basically means if you had like an S19J Pro, pretty standard rig, very common, you would only be making about $5.50 per day or $6 per day within that range. And that's not including that's not profit, that's just revenue. So that's not even adding in your operational costs, electricity costs. That put a lot of miners basically at break even. If you didn't have 6 cent or below power, then you were not making any money, or you were just actually treading water at that point. And so going into 2023, it was pretty bleak. You had, at the end of 2022, you had Core Scientific declaring bankruptcy. That same year, you had Compute North, the largest private hosting company in the US, go through a Chapter 11 restructuring. And it seemed like there was just going to be more of that coming down the pipe for a lot of the public miners. But then, Bitcoin basically reversed course, started ripping over the course of 2023. Probably the biggest thing too, though, that kept hash price buoyed last year were ordinals and inscriptions. So, Casey Rodomore, this Bitcoin developer, comes out of nowhere the end of 2022, and then in January of 2023 publishes this standard for Bitcoin-based digital collectibles and non-fungible tokens. Long story short, that ended up creating a transaction fee bull run that coincided with Bitcoin's own bull run, and hash price ended up performing much better than what most miners thought it was going to be. I mean, you're going into the year about $60 per petahash per day, and there's always some guy with cheaper electricity than you or with more money to deploy than you, right? So as hash rate increases and difficulty increases, hash price gets chipped away because you are now competing with more miners for block rewards. So your chance of earning a block reward is much lower. But through, I think it was May of last year, because of an inscriptions activity, hash price ended up spiking to like $120 per hash per day. I don't think anyone really saw that coming. And it just kind of continued throughout the year. You had some volatility from the transaction fees, but it was a much better year last year than I think most miners would have anticipated. I think the average hash price is like $80 per petahash per day, which is still not very good compared to 2022's. It was 120, but it's a hell of a lot better than being at all-time lows, right? So
it was an interesting time though. Remember, because there was this whole concept of hash price floor. If hash price got to a certain level where miners are unprofitable or even insolvent, they're, theoretically their hash would come offline and it would kind of solve for it and go back up from there. And I know internally we discussed it a lot. Is there really a floor? Like, what is the floor? It really depends on the miners and their energy costs and the efficiency of their machines. But we kind of tested the theory, right? Colin, we got down to 55 and it hung out down there for a little bit and then bounced. And then, as we saw, we had that crazy bailout with the ordinal spike where it went moon overnight. So it was definitely an interesting time to watch.
Yeah, and that's a good point too, Matt. Sorry if I could just piggyback really quickly, Sam.
Sure.
The idea of we always talk about hash price floor, hash price equilibrium, because when you think about what Bitcoin miners are doing, is they're competing for a fixed supply of Bitcoin mining rewards, right? And the amount of demand for that depends on a lot of things, namely Bitcoin's price. Transaction fees we're seeing are more important now than they have been. But that demand is also, affected by, funnily enough, it's kind of circular, how much demand there currently is. So if hash price is too low, then you don't have the ability to deploy more machines worldwide, or most miners won't, because they're not going to be profitable enough to do so. And hash price is ripping, more machines are going to come online. So there's just constant tug of war of economics that are happening with miners. And as I like to say, there's always some guy with cheaper power than you. So that's always going to have to be factored in.
We've seen hash price recover a little bit, but like you said, it's still below the 2022 levels. But bouncing off of what you just said, we've seen hash rate just go bonkers. I mean, if you think about the Bitcoin price, hash rate is probably the only thing that's just even a more impressive chart over the last year or so. It's just gone parabolic. And so how do you reckon that, in terms of, hash price still being depressed, but then you see hash rate just ripping?
Well, they're related, right? So the higher the hash rate, the lower the hash price. And if you go back in time, unfortunately, hash price is on a slow descent to zero, just because, you have the halving, you have, generally increasing network difficulty. And so as network hash rate is ripping, hash price is going down. And unless Bitcoin's going to the moon at the same time.
Right.
And so, so it's just got this inverse relationship.
Yeah. And to your point too, Sam, it's how are we still going up even when hash price is, Matt said, it's trading in backwardation, right? So backwardation, meaning like you can expect the future value of hash price to be lower than what the spot value is currently. I do think that, again, 2022 or 2023 furnished more opportunities for growth than miners might have thought already. The other thing too is, speaking from, I think, two sides. So like most people focus on public miners, right? The public miners sold crap tons of equity last year. I mean, I think they raised somewhere north of like $1.2 billion through typically at the market sales. And when you have something like that, you know, when you have basically these companies whose stock prices are supercharged on Bitcoin's own ascent, right? Then they can go out and purchase a bunch of rigs that are next generation, like the S21, T21, M60 series, that have much higher hash rate output and relative to other machines, lower electricity input. They're more efficient, right? They're like, the S21 is like, I think 16.5 watts per terahash. The S19J Pro, kind of the industry standard to this point, is 30, right? There's always advancements in the computing power that drives the Bitcoin network forward, and a lot of the big guys in the public markets have the ability to just purchase, you know, boatloads of these things, or truckloads, I should say. The other thing I would also say is, I think sometimes, and I'm guilty of this too, in like the North American context, we're so focused on what's happening in the US and Canada, and in some cases South America, for basically like the Western mining scene. But, you know, it's a global network, and there are jurisdictions where you don't have miners beating their chest that they just spot like 1,000 or like, you know, like 10,000 like S21s or whatever, right? And that they're going to try to increase their hash rate by like 50 exahashes by the end of the year. You know, the Russian market is quietly popping off. When I was at World Digital Mining Summit, one of the things that I really took away is a lot of the secondary market sellers were saying, for the ASICs, were saying that was Russian clients were their biggest clients last year.
Wow.
So yeah, I mean, it's something that, and you know, they've got loads of cheap coal and nat gas. So as long as you've got cheap enough energy, and if you can get your access to the newest rigs, then hash price can, you know, your margins are going to be much healthier. You know, you got a guy with, sorry, go ahead, Matt.
I was just going to say, and then, you know, during that period of lower hash price typically equates to lower ASIC prices. So the people that are, you know, generating more dry powder through, you know, selling equity or just had it on hand could buy cheap ASICs. And then coupled with, you had a whole year of site development that was going on. So all these kind of can, you know, kind of go together to skyrocket hash rate.
That's a good point.
I mean, you brought up the equity raises, and that's very different than in 2022 when there was a lot of debt raises where these companies got extremely indebted. Whereas they're kind of like diluting their shareholders now, the way that they're raising capital, they were very, very vulnerable to swings in the market when they had that much debt. And that's why we saw some of these major companies go under. And I think it just goes to show that these miners have to maybe think about treasury management or ways to hedge their risks. And this is where, Matt, you come in with the head of derivatives, of providing these products, these financial products that allow miners to maybe hedge out some of these risks. So let's get into that a little bit. Let's talk about like the derivatives market in general, why these products could be useful for miners to kind of reduce some of the risks to the market, as well as other factors.
Yeah, for sure. Thanks for the opportunity. So we have two different markets that we operate right now that are forward markets, and they actually serve two different use cases. One, the one that you're asking about. So our flagship product is what's called a non-deliverable forward, which is kind of like a technical term that describes a cash settled instrument where miners can lock in a hash price for a given amount of time and price. And so basically we operate the market. It revolves around our hash rate index. So, you know, just to kind of take a step back, hash price itself is basically what pools use as a methodology for payment to their pool members. And it takes Bitcoin price, network difficulty, transaction fees, and the block reward into a payment that says, all right, for 1 petahash a day, you can expect to receive X amount of dollars or X amount of Bitcoin on a day. So we operate this index. The index is calculated every 15 seconds. And much like traditional finance markets, we built a derivative around it. So the index is the underlying. And basically our forward markets allow miners to say, all right, let's say I have 100 petahash. I want to lock in $85 a petahash per day for that 100 for the next 6 months. You come to our market, you sell in our marketplace, and then effectively what you've done is you've gotten yourself revenue certainty for that amount of hash rate. So market goes down, we pay you in cash to make up for the difference. Market goes up, you're losing on your hedge, but you're more profitable. In either case, you've got a flat, predictable revenue that can be used to say, all right, well, now we know what our free cash flow is for the next 6 months, and we can work around our operations and do more robust planning around that. So that's the one market, and we launched that, about a year and a half ago now, and miners can comfortably sell multiple exahash on there out to 6 months. The other one you mentioned, dilution and issuing equity for miners. We also offer a product where miners can sell their future production. So same scenario, let's say you have 100 petahash and you want to get the amount of Bitcoin that you would produce in 6 months, but you want to get it today. We have a product for that too. And so effectively a miner can say, all right, I'm going to sell my 100 petahash for 6 months. We have buyers that will give you the Bitcoin in advance right now, and then you can use that to buy ASICs or pay down debt or pay for your energy costs. And effectively, these are products that we've launched in the Bitcoin world, but they exist in all traditional commodities. We are not reinventing the wheel; we're just kind of applying that wheel to this space. But you can see these types of products in oil and gas and corn, wheat, soybeans, metals, you name it.
Yeah, that's one of the big problems with running a mining operation, right? Is that your primary revenue, it's unpredictable.
Exactly.
Given the randomization of SHA-256 and proof of work, you don't know when you're going to win that block reward. And so you have fixed costs, you have server costs, labor costs, other operational costs, maintenance costs, but then your primary revenue is completely uncertain.
And so volatile. Very volatile.
Yeah. So it makes sense that they have these products that they can use to kind of smooth out their revenues to kind of plan ahead. And so, but you guys launched a brand new product, right? The hash rate futures, which was really interesting. I want to throw up this chart, and I just never really thought about this, but it looks at hash rate, as a commodity itself, and the volatility of the daily returns per commodity. And you see that only natural gas is more volatile when you compare it to other commodities, and Bitcoin's on there and it's right in the middle there, but hash rate's even more volatile than that. And so is this part of the reason why you guys saw this as an opportunity to have a hash rate futures product?
Yeah, 100%. I mean, when I was actually interviewing at Luxor, the guys pitched me on the space, and they're like, all right, if you look at the mining world, and let's say you're a miner, you effectively have three main risk exposures that you got to manage. You have to manage your energy cost, the cost to run your operations. You have to manage Bitcoin price, assuming that you have Bitcoin on treasury, and then you have to manage your revenue volatility. And so, if you're a miner, before we launch these products, you can manage your energy costs either through PPAs or energy derivatives. There's tons of those, and they're fully mature. Bitcoin is similar too. There's tons of derivatives for managing your Bitcoin treasury, but there wasn't anything to manage your revenue. There's a couple other people that were trying to do something in this space, but the liquidity wasn't there. And so that was the gap that Luxor has been trying to fill. And so, for us, we just wanted to get that third piece for our miners to be able to get more revenue certainty. And then also to give other people exposure to the space. So, miners are the sellers of this product and they're using it to hedge, but there's also, crypto native hedge funds, family offices, proprietary trading groups that are trying to get exposure to the space in a more holistic way. And this product gives that to them.
And Colin, how do you see this kind of developing? Do you think hedging strategies with products like this, you think it's just going to be the norm for mining operations next year, the next 2 to 3 years?
I hope it is. That'd be that's what we hope at least. Well, I mean, I hope of it. I hope for that just because obviously I work at Luxor. I want to see this product succeed.
Right.
I would say that it makes sense to me kind of in the sense that, so right now miners can hedge, before hash rate futures and forwards, miners could hedge two primary inputs, right? They could hedge their electricity costs and they could hedge Bitcoin itself. But now they actually have a native tool to hedge their mining income. And as Matt was saying, these kinds of instruments exist in all other commodity producing industries, right? Like these are widespread in agriculture, in mineral production, oil, things like that. And I think that, going back to what we were saying about hash price, the fact that it trades in backwardation, it's going to be something that most miners are going to implement in the future if they want to make sure that they can actually maintain any sort of of steady revenue, or if they want to make sure that they can hedge that revenue from things like swings and transaction fees, which are becoming obviously more and more germane, or that conversation is becoming more and more germane with alternative uses of block space and just adoption in general, right? I think the other piece too, when you think about the halving, as we continue to have successive halvings, those transaction fees will continue to make up the bulk of block rewards, right? So theoretically, all things being equal, hash price will be more volatile in the future than it is now, because miners will rely more on transaction fees, which is a major component of hash price for their revenue. So I think that as time goes on and the industry continues to mature, this is going to be something that most miners will want to take advantage of. And, you don't need to do it for your entire fleet, but, if you've just got a portion of your operations hedged, just to make sure you're covering your ass in the case of extreme downside. I think the other thing that Matt pointed out to me a while ago that's always stuck with me, going back to the debt equation, something like forwards and futures actually give miners the ability to lock in their revenue so that they can go to lenders and say, you don't have to worry about us going belly up over the course of this loan. We have revenue guaranteed for X amount of months that we can use to cover this debt if we need to. And, after 2021 and 2022, lenders got very soured, or their appetite was totally soured for lending to some of these mining companies. The other problem is rates started raising. So the kind of ASIC-backed loans that we saw in the last cycle are no longer tenable, because they were already like 15 to 20%. Now they're even higher than that. So something like this could potentially open up new avenues for debt financing for miners that they haven't had before.
Yeah.
Which could help everyone down the stack, from small to large miners.
Yeah. No, first of all, I'm so proud of you, Colin. You know all this stuff. You don't even need me anymore. But the truth is, like, if this is an oil and gas space, like, it would be a prereq for you to be hedging some percentage of your production if you're trying to go get debt or financing for stuff, right? Like, they would say, we need to see your hedging strategy and how much production you're hedging. So, like, and it's also important to remember the space is super young, the mining space, right? Like, it's like a decade old. There's still a huge maturation path to go. And we're seeing more and more adoption. Sam, you asked, like, are people using these things? It's been kind of a slow grind of education and getting people familiar with how hedging works. And, it's a hodl culture, right? Like, people are like, let's hold and ride. But, they're starting to realize that it doesn't always work. And, like, you got to be cognizant of, like, what's going on around you and be a little bit more prepared for, your business. And so we're seeing, like, a huge adoption, basically starting in like Q3, Q4 of last year. I think people were trying to get prepared for the halving, trying to understand what their tools are and manage their margin more effectively. So it's been quite an uptick.
Yeah, you hear Joe Kernan on CNBC say, prepare for the halving, but it's never more true than for Bitcoin miners to prepare for the halving. So how are they preparing? Because I know there's different ways to do it, and kind of what are you guys hearing? What do they need to do? And then maybe we can go into, like, which mining companies do you think are, like, best positioned? So how are miners preparing for the halving, and then which miners do you feel like are in good positions to kind of thrive post halving?
Yeah, I think last year was when they really started setting the groundwork. I mean, you really wanted to be thinking a year out or longer in terms of how to position yourself well for this event, right? I think we covered one of the things, right? Like, miners sold a lot of equity last year. So they padded their balance sheets with a lot of cash. A lot of them shed debt. They used some of that cash not just to pay off debt, but they used it to also expand their fleets and buy next generation ASICs. They also used it to develop new sites, like Riot developing their 1 gigawatt immersion site in Corsicana, Texas. I'd say that the biggest things that we've seen, at least in the public markets, because all of that's all of that stuff is totally disclosed in SEC filings. They've been stacking cash. They've been much more prudent with treasury management. They're no longer just like Matt said, hodling and letting it ride. They're paying off debt and they're expanding their fleets and trying to get their efficiencies up. So I'd say that that's what we've seen the most. And obviously they're also hedging their revenue uncertainty with Luxor's hash rate forwards. But so, yeah, I think that it's kind of just the basics, right? You want to be debt light. You want to be cash heavy. You want to make sure that you have the latest generation machines. We've seen strategy shifts too. Like Marathon used to be super big on asset light. That was their whole pitch. They just bought a bunch of machines, hosted them around the US, and they recently bought 2 facilities that Compute North essentially relinquished to their lender in the bankruptcy. I think it was the Kearney, Nebraska facility and Granbury, Texas. I could be wrong about the Texas one, but Marathon recently purchased both of those from Generate Capital. And so we were seeing their strategy shift from asset light to, actually, if we're going to survive long term, then we're going to need to vertically integrate.
What about you, Matt? Like, what do you see in terms of the halving? One of the things that you see in past halvings is you see a large decline in hash rate as mining operations become unprofitable or old machines come unprofitable. You see them flip off and you see kind of a sharp decline in hash rate post halving. Do you think we're going to see something similar?
I think it's going to be a bit muted. I think with this cycle, we've seen, probably over the last 6 months, is a huge amount of effort going into refresh of machines and trying to get more efficient machines. So I don't think, outside of maybe a couple exceptions, there's probably not a whole lot of people that are just sitting on a bunch of S9s that are going to turn off. Like, maybe there's some of them, but I don't know how impactful that'll be to the overall network. I think people are more prepared. And then also, you had this unprecedented pre-halving Bitcoin run. Typically that's happened at, a month or so after the halving. But we've got, miners got this nice cushion going into it that wasn't expected. And so I don't think it'll be quite as dramatic as we've seen previously. Although, who knows?
Yeah, right. I mean, Bitcoin could get a 20% haircut over the next week, and then the equation completely changes.
That'd be awesome.
It's not weird.
Yeah, discount.
It's not weird for it to get a 10% haircut in a couple of days. Like 20, 30% is not unusual. And so, to your point, like you could get a massive drop right before. But I don't know. I personally don't see that. Sam, I think we might see some effect at the halving. It's probably natural, but I don't think it'd be nearly as much as we've seen previously.
Yeah, and just to piggyback off that, we build projections for hash price, hash rate, and difficulty at Luxor. It's part of some of the research that we provide. And we have a halving report coming out tomorrow where we actually look at a bunch of these different scenarios. So like looking at a base case hash price scenario, bull, bear, stress case, and super bull scenario. And if we stay if we stay at the trajectory we're at right now with Bitcoin's price, and the current rate of hash rate growth, it's conceivable that you only see as much as 7, maybe 10% of network hash rate come offline after the halving. Because just to kind of give an idea, like right now, hash price is at about $102, $103 per petahash per day. So if the halving were to happen like right now, then that would go down to like $51, $52 per petahash per day. And that's not too far off from all-time lows, right? And that was at a time when we had, the average fleet efficiency was not as good as it is currently. To what Matt was saying, miners have next generation machines. So, it's looking like, at least in the immediate aftermath, it's probably not going to be much. And if Bitcoin really continues to rip, then it might not be any at all.
Well, energy prices have come down too. And that's the other thing. People have spent a lot of time, they got run over with high energy costs, like while Bitcoin was tanking. It was like the worst possible scenario. But now we're seeing the inverse. So, there's some cheap energy out there, and I think people have made put a lot of effort forth to get better energy contracts. So that kind of lowers your floor a bit. But also, to what Colin was saying, I was just looking at our forward market. I think the market's pricing in somewhere around, $54, $55 post halving for a hash price,
which is crazy.
Yeah.
That's crazy.
Yeah. What would be a hash price level where these, let's say public miners would start shaking in their boots a little bit and really struggling? Like, is there a level where you're like, oh, people are going to start struggling here?
It's not that much lower than that, I can say that. But yeah. But originally I think we were saying something around like 45, 50 after the halving, but I think that's improved since we last looked at it. So I would say, somewhere below 40 where I think people would start getting nervous.
Yeah, I think that's probably right. I mean, and it depends on what machines they have, right? Like, assuming they've got all S21s, which they don't have, but like in a perfect world, they have all next generation machines. Even at $40 per petahash per day, your break-even electricity cost is like $95 per megawatt hour. So like $9 and for smaller miners, like our home miners out there, like 9.5 cents per kilowatt hour. And
or 16 in our home state, Sam.
Hey, it's not bad. You could be California and rocking 35.
That's true.
This is like just absurd.
Yeah, I got a couple S9s over here that are just
But yeah, I think if we assume that most of them, and a lot of them do have like roughly like 28 to 30 watt per terahash, joule per terahash efficiencies, if we break below 40, they're not going to be having a good time for sure. Some of them will, at least.
Got it. Well, it's something to keep an eye on for sure. I know I always check the hash price because I think it's there's a lot of information packed in that one metric, honestly.
Yes.
Yes. Yeah. And so, but you still have hash rate running. You said you're hearing whispers that a lot of Russian buying is happening.
Yeah. I can't confirm. I've been told.
Can't confirm.
They've got hash rate
whispers. But what are the odds that, like, is hash rate just going to continue going up? Because I feel like a lot of these new machines came online finally, and it seems to me like it could slow down, but we still seen it just continue to rise. Like, what are the odds we actually get to like 1 zettahash next year, maybe, like at this rate? It's wild. So like,
it's going up forever, Laura.
It's going up forever.
It's going up forever.
I mean,
I think there's a
capacity
chance we get
into it too, right? Like, there's an infinite capacity for this.
Yeah, the capacity is one factor too. So it's like, what are some of the constraints, I guess, to hash rate, or to like what would make some of this like cool down, I guess?
I mean, definitely supply of
supply of ASICs and capacity to
it just takes time to build out the capacity.
Yeah, that's it for sure. I mean, that is the thing, right? Is like you can't just buy a bunch of ASICs and just like throw them at a energy generation source and just have a good time. But that's one of the things where like the capacity problem becomes easier with time as you have more professionals working in the mining space who build out expertise in constructing these things and running large scale farms. I think that we might get a zettahash by the end of next year. We definitely won't get it this year. I actually feel pretty strongly about that probably not happening. It's definitely in the cards, I think, for next year. I think the biggest thing though is like in terms of like how high does this go? Once Bitcoin mining is a feature of energy systems, and it's just like all bets are off. Agreed. Like and like I think that's probably just going to happen eventually, unless Bitcoin just stops existing or it just craters in price or it becomes less relevant. But you're building out in literally any energy system, hydro, nuclear, solar, wind, nat gas, like plugging in a Bitcoin farm at a certain scale just makes sense. I think that's probably, this is not like an original take, but I do think it's probably true. Eventually you're just going to have Bitcoin miners will not exist in like 25, 30, 40 years the way they do now. There will be people who specialize in it, but like the largest miners will be energy companies, and they will be energy operators. And one of my favorite kind of scenarios that I've heard described is actually from our boy Drew Armstrong. Talks about how, like, 20 years into the future, you could see conceivably wild swings in hash rate when transaction fees, let's say they like just moon overnight and go from an insubstantial amount to a substantial amount, increasing mining revenue. Then you could basically just have like data centers on some of these power plants that just fire up to capture that revenue in an intermittent time frame, and then they just turn off once that's no longer juicy. So I don't know, it's like kind of like a far out thing to think about, but I really think the ceiling is kind of like Matt said, as long as there's energy supply and capacity, then this thing just keeps growing.
Yeah.
What do you guys, Bob Burnett brought this up on Swan Signal, and it's something I've just continued to think about because it makes so much sense to me. But he's like, the merging of the energy industry and the Bitcoin mining industry might be a little overblown, and what's not appreciated is the potential merging of the financial industry and Bitcoin mining. And it's because of these ETF issuers who will want to actually control the block space, and they're really quicker to move and they have the funds than say an traditional energy company. And so somebody like BlackRock or somebody like a Fidelity could really come out and start, either acquiring Bitcoin miners or like setting up their own operations so that they can actually control the block space to manage kind of the plumbing of their ETF products. What are your guys' thoughts on that? Because that's an interesting theory, and it makes a lot of sense to me in some ways.
Yeah, what do you think about that, Matt?
I think it's super interesting. It's kind of timely too, because it's not a direct answer, but we're launching an exchange listed futures contract. So the other two contracts I mentioned were our forward contracts that trade over the counter, but we're doing one that's literally on a Bitcoin exchange. So people have access to it. And we made the announcement on Tuesday, and we're going live in a week. But I've already had people like kind of asking, if we'd be interested in doing an ETF on it. And I was like, wow, that was really quick. We're not even live yet. It got me thinking though, like and like I was thinking, to your point's a little bit more interesting is, if you do control the hash rate and you can do it in that way, I think it's a legitimate scenario. I think, it's not just game theory. I think it's pretty far afield from here, but I would be surprised if they're not thinking about it.
So I guess my question is, what is the benefit? Is being able to produce Bitcoin under spot so that you have even more?
I think the idea is there's a bit of dependence on a third party, mainly the pool coordinators, to actually include transactions when they're trying to actually do the plumbing of the ETFs, how much they have to move Bitcoin and transact in Bitcoin underlying the ETF every single day as they settle it. They'll want to have like at least run their own operations just to make sure it's running efficiently. They don't have to trust another company, or at least partner with one specifically and build a relationship with them.
Yeah, this would be a massive endeavor though. Like that's
it would be huge,
insignificant amount.
And I think they would probably end up using Luxor team, but they would probably just end up using like a foundry or something like that, right? Like they would end up using.
Yeah. Why do you say that? Why do you think they'll likely do that
because like it's just so much easier, like to just like there's a reason pools exist for Bitcoin miners, right? And it just makes everything a lot easier. Having to actually stomach the variance of block fines is brutal. Maybe these guys have enough hash rate to where it doesn't matter as much, but even just like managing that architecture and trying to run everything smoothly is just a very, very difficult thing. And so I think that they'll probably just try to make it as simple as possible. And just using architecture that's already in place makes sense for that. I do kind of see, or acquire it.
Yeah, acquire it, not use
it. Yeah, that would make sense too. And I guess I could kind of see the benefit of this from the ETF perspective, because instead of having to go through a custodian and like bidding, you know, against everyone else, and like you're driving up the spot price of Bitcoin, you can just like produce it yourself and bring it in to feed your ETF rather than having to go to some sort of broker and try to buy like, you know, tens to hundreds of millions of dollars of Bitcoin.
Yeah, you can
But
source.
then they're not going to, yeah. But then again, like if there's huge demand, it's going to outstrip what they can mine anyway.
Well, they're already approaching miners to buy directly from miners.
That's crazy. We're going to see the mythical Virgin coin premium come up.
Yeah.
the premium.
Yeah, there was like this thing that went around like a long time ago where it's like institutional desks want to buy like clean Bitcoin, like
Clean
virgin
Bitcoin,
Bitcoin,
yeah, I know.
like just
I
out of
always
the
hated
block
that.
at spot. Yeah, it's so funny. It's like, dude, no one's like, they don't care. They don't know enough about how this stuff works to actually do that.
Yeah, that was like a narrative, I think, in like, I don't even know, 2020, 2021.
Yeah,
the clean
for
Bitcoin
sure.
premium.
Well, that's like the rare sat thing, right? So there's always people that are kind of like fishing for rare sats.
Hey, rare sats have numismatic value, sir.
Yeah, but my point is like Coinbase doesn't even realize that they're sitting on all these rare sats and people
Yeah, I know.
sifting them out of there without them even knowing.
Yeah, for sure.
Is Bitcoin not rare enough for these people? You know,
man,
they're just
people will gamble and collect anything.
No, it's like someone trying to collect a wheatback penny. It's gonna have value later.
Let's talk a little bit about like, I guess, the global nature of Bitcoin network and decentralization. Like that's one of my favorite graphics from your report was like just looking at the different mining operations throughout the country, but also the world. So like, I don't know if Jacob can throw up maybe the United States one.
Yeah, there it is. I do like this graphic.
It's cool. It's cool. It kind of shows. I always think of it's cool that hash rate is in the United States because we have like state law. And so it makes me happy when I see different operations in different states with different state laws. I think that's a good thing for Bitcoin's network. But if we could just share a couple of these other graphics too, it's not just the United States that you guys went through. It's also Norway and Sweden and Iceland. You saw different public miners setting up operations abroad.
Holding it down for Europe. Like
holding it down for Europe, yeah. And then in the South, you saw Argentina. I remember when Bitfarms and Marathon announced Marathon in Paraguay, and then Bitfarms in Paraguay too. And obviously Bhutan, that's with BitDeer, I think. And then UAE's, I think, Marathon as well.
Yep.
So we're seeing a kind of public Bitcoin miners start to build some operations abroad. Do you guys think that's a trend that we'll continue to see, and why?
I think they're chasing energy. Like some of those are like around, hydro dams or other sources of cheap renewable energy. So yeah, I think for sure. I think it'll be more and more dispersed as people come up with creative ways to get cheaper energy. Just looking at that chart, I think a lot of that geographic dispersion has to do with where the cheapest operations can be. I don't know if you feel Colin.
No, that's exactly it. I think chasing energy is a great way to put it. Like Paraguay, right? The Itaipu Dam is like the second largest dam in terms of output in the world.
Yeah,
it's just massive. Paraguay has no real way to consume that energy. It's a country of like 6 million people. The majority of that gets ported to Brazil, country of like, 100, 200 million people. And same thing with the Middle East. There's very energy rich over there. There's a lot of energy assets in the South America and the global South in general. I think you'll see continued development in Africa. Ethiopia has a lot of hydro assets. So I do think that you'll see that trend continue. And I think it's probably for the best. As much as I agree with you, Sam, it's kind of nice to have some hash rate in the US. I also think it's a good, like the balance of powers in the US between the federal government and the states is important, because if the federal government actually tried to do an all-out ban of Bitcoin, you'd have hash rate rich states like Texas, Georgia, and other places basically fighting to make sure that doesn't happen, I would think. But I do think I would like to see North American hash rate dominance wane a little bit and have that spread out. If there are any real attack vectors on the Bitcoin network, I think like regulatory attacks on block production would be one of the easiest ways to do it. And then the unfortunate truth is like, at least in the US, you don't even have to have all of the hash rate in the US to do that. You just have to go to the public companies for instance, and tell them to like censor certain transactions that they don't like, which I actually don't think is talked about enough.
Yeah, no, I know. And then, yeah, that's why I thought, like, do you think maybe some of these public mining companies are doing this for like regulatory arbitrage as well, where it's not solely just chasing energy, but also they're trying to diversify that risk?
I would say
I don't know.
It's probably an added benefit, but it's not the primary driver. It would be
yeah, for sure.
Yeah,
and again, they're all domiciled. I mean, not all of them, but like the vast majority are domiciled in the U.S. So, you know, even if they say it's like, well, like 90% of our operations are in the middle of nowhere in South America, the government's going to be like, we don't care.
Yeah, we don't care.
You're a U.S. company. You file with the SEC. Like, do what we say. But
let's talk about like censorship of transactions, because we saw like the third largest pool, F2 pool, was basically discovered by an online sleuth that they censored some transactions to comply with OFAC sanctions. Obviously, that's a problem. There are some solutions, I feel like, in development, like Stratum V2 and the Ocean pool. Like some of these solutions kind of trying to address this problem of, I guess, centralization risk at the mining pool level. How big of a problem do you guys think this is? And what are some of the solutions that you're looking at? Do you think those are viable solutions that I just mentioned? Would love to hear your thoughts.
Do you mind if I take first stab, Matt?
No, yeah, by all means.
So the OFAC thing is interesting, and it's been, I guess I'll answer your first question or your last question. Like, it's not really a problem right now, but that doesn't mean that it won't be a problem in the future, right? Marathon was actually one of the first pools to try to do that. You know, they built like an OFAC compliant pool, and then they just stopped doing it because they got some heat.
There's a lot of backlash.
They were also making less money. You know, and I think that's the other thing too, is like there's an economic incentive here. Maybe not so much when transaction fees are popping off in general. And now Marathon has Slipstream for non-standard transactions for things like inscription. So like they'll make decent money with that. Do
you think that's a problem? Because there's a lot of people who think those out-of-band transactions are an issue.
I don't think that that's so much a problem in as much as like the way that we see it manifesting currently, it's, you know, mainly for like just, you know, I'm not against inscriptions and ordinals. I don't really get them though. Like, I think it's just like a game of music, of financial musical chairs. And so it's like if people are gambling on things like that for those out-of-band transactions, and like go for it. I don't think that is necessarily super dangerous. Like if it's just inscription stuff, that's one thing. If we ended up getting MEV, like miner extractable value scenarios where you can do like certain arbitraging things like we've seen on Ethereum, then I think it could potentially be bad. I don't think that there's a chance for that currently, because to have those kind of incentives, you would have to have actual DeFi applications on the primary chain, like on the layer one chain. And like Bitcoin's just never going to have that, right? Like anything that's Turing complete or DeFi compatible will be a second layer thing. And maybe there are MEV exploitations that can be explored then, but I don't know what those would look like. But one last thing just to hit on, you mentioned Stratum V2. I think Stratum V2 is great, but the thing about Stratum V2 is like it's only as powerful as how many people are using it and how big the miners are who are using it, right? Yeah. Like if you're like a miner with like 10 machines in your garage and you're running Stratum V2 to build your own blocks to make a difference, like I'm sorry, bro, it does not matter, because you're never going to hit a block anyway. So like any templates that you build are never going to be mined and accepted by the pool that you're using, right? That being said, it's a good thing. Like Stratum V2 is a good thing to have. It's just like it in itself is not some smoking gun. You actually have to have adoption of it. And on that note too, go ahead.
Well, I'm sorry, but just like why won't pools adopt it? I feel like it's a massive upgrade than Stratum V1 for a lot of reasons. Like they're encrypted messages, it's faster, better latency. Like there are advantages, and then there's also the advantage of, you know, allowing miners to build their own block template, which is the, you know, centralization issues that we talked about, which Stratum V2 addresses. Yeah. But there are also other reasons why a pool would want to adopt it, but like why wouldn't they, I guess is what I'm saying.
I don't know. I honestly I don't have seriously, I don't have a good answer. I think that there are probably like myriad reasons why a pool wouldn't. Some of them may be more sinister than others. Some of them could be as easy as you know, I won't say this about mining pools specifically because like we have, I really respect the guys who have built Luxor, especially like our senior leadership, like Nick Hansen and Eddie Wang. They're brilliant programmers and they understand the Bitcoin protocol pretty well. But I think like on like a base level, like most miners are pretty like technically, they're pretty technically deficient compared to a lot of other Bitcoiners who are like paying attention to a lot of this stuff. They really only just want to mine and make money, right? So it might be, Bitcoin miners, kind of have all of their, like the mining pools have like all of their own like internal architecture and they have different ways of doing things. Maybe it gets down to that level. Maybe some of it is even just competition with the fact that like Brains Pool, formerly Slush, put it out. So they don't want to use, which I guess doesn't necessarily make sense because they're already using Stratums anyway, which was like, the Stratum V1 that Slush came out with, when they started doing mining pool stuff and iterated on since. Like I'm pretty sure every mining pool uses that to pool hash rate. So I don't really know why they wouldn't do V2. I do think, to your point, it'd be benefit to everyone. And the last thing I would also say, it's like I don't really agree with some of the censoring of inscriptions, but I hope alternatives like Ocean Pool end up actually doing well, right? Like because if you actually do have a regulatory captured, segment of the mining industry that is going to censor those OFAC sanctioned transactions and addresses, it's going to be doing other things like that. You want alternatives, right? Like ideally you want an Ocean Pool that has a large enough amount of hash rate to where you can send a transaction if you're blacklisted and, it might take a while, but eventually it's going to get picked up.
Matt, do you have any thoughts on
that? I don't know if I can compete with Colin's depth of knowledge on this. I'm just the boring TradFi guy.
He's a TradFi boomer.
TradFi boomer.
I do find it super interesting, and like these developments have definitely given us some things to chew on internally and kind of strategize for long term. But honestly, I don't know. I'm kind of with Colin. I'm not quite sure why they wouldn't adopt. My guess is they will. I just don't know what the barriers are.
Yeah, I think there are some barriers. Like I think I'm not sure. I think there's some like technical effort that's required to actually upgrade to
Stratum. Yes, for sure. And on that too is like that assumes that your miners like want to use it. Like I'm going to be honest, I think that like probably 95 if not more like % of miners just like don't care enough. Yeah. Like big miners are not going to be constructing their own block templates. They're running businesses. They're not doing this for ideological reasons. They're doing this to make money. So I think that the ones who are going to do that are going to gravitate towards the pools who are like just already going to have that as a feature anyway, right? So
it's rough though. I mean, like if they think too short term about this stuff, it's the network that actually is how they make a living. They want to support the decentralization of the network. It's interesting that like the profit maximalist of miners, but at some point you all benefit from a healthy decentralized Bitcoin network. And it's also interesting because what we're talking about, if people don't understand, is it's basically Stratum's like a communications protocol that miners use to communicate with pools, create block templates, create blocks. It's how they communicate with each other. And Stratum V2 is just like an upgrade of that. But it's interesting because it's a protocol, so it kind of has a network effect, right? We always talk about network
for sure. And maybe we should have done this before, but like for people who are lost. So mining pools currently build block templates for the miners who mine with them, right? So what a block template is the block template is literally basically the construction where you list all the transactions. So when you're building a block template, you include the transactions that you want to put in a block should you win it. So right now, mining pools do this for their miners, and it's not really that much of a problem because the mining pool is incentivized to include the highest fee transactions in the block anyway. That's how the system is built, and so the mining pool will do that for the miners, and it's not really that big of a deal. But with something like Stratum V2, each individual miner can build their own block template, and if that miner if their machines end up winning the block that the mining pool mines, then their block template is the one that gets published, rather than having to rely on the mining pool to build that for them. So in the event, like we were talking about earlier, where mining pools are maybe asked or forced to censor certain transactions, something like Stratum v2 with the right mining pool could give miners the ability to circumvent those or fight back against that kind of censorship. But again, it also just it depends on, are they mining with a pool who is not forced to censor or is not going to censor, right? Because if they're using Stratum v2 and the mining pool is going to censor by default, then they're not going to accept their template anyway. But
yeah, this is the other argument too, is that like, is it overblown because ultimately it's the financial incentives and game theory that drive Bitcoin, and there's a very low friction for a miner to switch pools, right? To point their hash at a different pool. And so if they don't agree with, say, how a pool censoring, they could actually lose business, right? They lose hash rate as it just moves over to another pool because there's very low friction. But the issue is that although that's possible, technically, historically, we've seen kind of like hash rate stay with the pool. Like even if they do kind of some questionable decision making, we don't see hash really move away from it, even though that is possible. So that's why some people say like, hey, this is kind of like overblown, this risk, because hash rate can just move over. But the behavior that we've seen historically hasn't really been the case. So it's a fascinating conversation. It's definitely like an issue that really we should be talking more about, I think.
Yeah, and I think it depends on your assumptions of the actors, right? Like your game theory is only as good as like your understanding of the actors within the probability or the problem set. So it's like if you're a huge Bitcoin maximalist and you're like, well, if my pool was censoring, then like I'd go to another pool. It's like that's great, but like we were talking about earlier, as Bitcoin continues to be entrenched with like the traditional financial system, like honestly, like these people don't give a fuck. Like they just want to make money, right? They're not here for any sort of cypherpunk principles. They're not the garage shop miners who were running, GPUs back in like 2012, and screaming about Bitcoin until they were blue in the face. So I do think that it's easy enough to get them to switch their hash rate to other pools, but it's like, are they going to? Do they care enough? Mm-hmm. And I'm not convinced that most will, honestly. You'd be shocked at how many miners like are honestly like just so like technically ignorant and just like don't know anything about Bitcoin, but they like an asset that produces income, right? Like
those aren't our customers though. Our customers are very smart.
You're gonna piss off some miners, man.
I probably will. And I should caveat that like there are plenty of miners who are like that, but like I guess since joining Luxor, I've been shocked like going to different conferences and talking to certain people. It's just like, you talk about certain Bitcoin things and they just like don't care. It just like goes one ear in and out the other, right? But there are plenty who do care about it too, and I think that under the right circumstances, they will respond in a way that is disfavorable to censorship in the future.
Yeah. Well, before we go, I have to ask, Matt, your Twitter handle is interesting. Trading onions. I gotta get the story behind that because I'm just curious. what's the reason behind trading onions?
All right. Well, first of all, coming into Luxor, I was like, I don't want Twitter. I never wanted to get on Twitter, and I just kind of like got coerced into doing it. And then I have like the most ubiquitous name in the world, so Matt Williams is like finding that as a username is impossible. So I was like, all right, let me think about it. It's, I'm the TradFi guy. And then I remembered this like very interesting story in the financial world. So there's this thing called the Onion Act of 1955. And before Colin tells me that I'm a boomer, I was not alive during this. I just know this story. But effectively what happened was there were these two traders, and they went around, they bought all onions traded on futures. So they would trade on an exchange as a futures contract. So these two traders that knew some inside stuff about onions. So they basically what they did is they went up and they bought all the onions they could. They bought like 90% of the onion supply and just, hoarded all the supply.
They cornered the onion market?
Yes. So they drove the price. It gets better though. They drove the price way up, way up. And then they just shorted the shit out of it on the market. So they put these huge short positions on. And so right now everyone's like panicking. They're buying, these futures because, onion prices are going through the roof. So now they got this short position on. They flood the market with all these onions that they're sitting on. So they just flood all these farmers and everywhere, all these markets with onions. Price plummets. And like the joke was like at one point, the bags that held the onions were worth more than the onions. That's how bad it got. And they just made gajillions of dollars off of this. And ever since then, everyone realized they manipulated the market. You've never been able to trade onions ever again since 1955.
But you still can't?
Nope. There's no way to trade
onions.
There's no way to trade onion futures.
Really?
It's a true story.
No way.
That's just the wildest
Onion
thing.
Kings. Those guys are just.
Yeah. There's a documentary on it that's pretty fascinating. It might onions and trading might not appeal to everyone's. But it's a pretty interesting story.
That was so much better than I ever expected. Thanks for sharing that.
Yeah,
I gotta look that up. I gotta Google that now. I love
Right?
history stories like that. That's fascinating.
Yeah, it's super interesting.
I just can't believe you still can't trade the onions.
No, it's literally it's 1955 that they made it illegal. The Onion Act of 1955.
The Onion Act of 1955. Well, there you have it. Don't say you never learned anything new on this show. That's insane.
Onions and
Well, thanks for coming on, guys. I really appreciate it. That was a great conversation. And I feel like I have to say something, which is just like with these inscriptions and ordinals, I get worried that people will get confused about things that hold their value over long periods of time. And that's my big concern, is like newcomers coming into the market and getting confused with these things. And just know that there's nothing better than Bitcoin in terms of holding it for the long term. I have to caveat that because it's something that I believe in, and that's my big worry with these things, is that people are going to get confused, and instead of buying something that actually stores wealth over long periods of time, they're going to kind of YOLO into these things. And we saw what could happen in 2021, and I don't want to see a repeat for any of the listeners of this show. So that's my 2 cents on the topic. But
I'll add my 2 cents to that as well. So now it's 4. I completely
it's 4
agree.
cents.
I agree 100% with what you just said.
Okay, that's good.
Y'all are wrong.
Colin.
The one thing I would say is, like, I agree they should just be buying Bitcoin, but like, not to be really cold-hearted, but if you're new to Bitcoin and you think like, wow, like paying $50,000 for a monkey picture, like that's a good idea, and you have no edge outside of that, like, I don't know, man, you got other problems to figure out, like Bitcoin can't save you. Like, because that's the thing, is most of the people trading these things are doing it because they're traders and they're like degenerate gamblers. And so for those people,
it's the people that get burned that Sam's talking about. It's the greater fool theory. There's there's smart people driving the price up, but the people that are buying at the top are getting hosed. And it's up to us to educate them. This is a stupid idea.
It's a picture on the internet. Don't buy it. just stay away from it. So I guess I agree. Just buy Bitcoin.
I guess that's 6 cents, maybe, Colin.
6 cents. Yeah, maybe 6.5.
But I just had to say something. But
I appreciate it. No,
I really appreciate you guys coming on the show. It's always been fun to reconnect with friends, and Luxor puts out some of the best research on mining, like bar none. I was just blown away by the quality of the report that I read in the 2023 review. So maybe we'll put that in the show notes, or you can go check it out. You said you're having reports coming out. I don't know if that's going to be publicly available or not.
It will be. Yeah, it'll be on. So hashrateindex.com/blog tomorrow. I probably will send out the newsletter and publish it tomorrow morning.
Oh, awesome.
So it just looks at different scenarios for what could happen with hash rate, hash price, things like that.
It's also free to look at our futures curve on our website. So luxor.tech.
Yeah, check out the futures curve. Congrats on the launch, Matt. Very cool. And so congrats on the hash rate derivatives launch. And guys, thanks for coming on the show. Where can people find you if they just want to? I guess we know Trading Onions is one, although you don't tweet a lot. But
I read it. Hit me up on Trading Onions.
Yeah, Trading Onions. And where can they find you, Colin, if they want to follow some of your work?
Find me on Twitter at As I Lay Hodling. And just you can subscribe to our newsletter at Hash Rate Index. Get all of our research direct to your inbox whenever we publish it.
Awesome. Cool, guys. Well, have a great rest of your night. Appreciate you guys coming on again, and maybe we'll have you back on sometime soon.
Thanks, Sam.
Appreciate it, Sam. This was awesome. Thanks, dude.
Yep.
Well, mining is just the topic du jour right now because of the halving coming up, and all eyes are on, I think, April 20th around there is when people expect the halving to happen. The implications for the mining industry when their revenues basically cut in half, everyone's wondering some of the things that's going to happen. So hopefully this episode kind of helped illuminate what could possibly happen, but we'll just have to wait and see when that happens, of how the mining industry is prepared, if they prepared enough. And it was just great to talk with Matt and Colin on the show to kind of help share their expertise and their insights on the Bitcoin mining industry. And so I hope you enjoyed it. You can like, you can comment. Make sure you subscribe to our YouTube channel if you haven't already. That always helps us get our message out. The algo loves it. So if you haven't subscribed, we really appreciate your support. Leave a comment. Let me know what you thought. And like and subscribe, like I said. But also, we have another great episode lined up next week with another great guest. So make sure you tune in. And I appreciate it. And with that, I'm out.